Hi, I'm Jerry Slusiewicz. Welcome to one of my Money Talks videocasts. Today is Wednesday, April 11th, 2012. I'm here to kind of give you a recap of where we think the market is and where we think we're going. The market's had a great first quarter. If you've been watching these things, you're aware of that. I predicted that the second quarter probably wouldn't be as good as the first quarter. And, there's some historical trends that at the end of April, you want to kind of sell in May and go away. That doesn't guarantee anything because the market doesn't have a calendar or wear a watch. But the last 2 years, last year I think the market peaked on May 2nd, and the year before it was probably around April 29th, 30th. And here we are, April 11th, and it seems like the market might have peaked 5 to 7 days ago. Markets got hit pretty hard. We had 5 down days in a row, depending on which indice you looked at. Today we had a little bounce back up. Typically in a bull market, after 5 days of selling, you usually get a little bit of a bounce. We did get that today. But the big key is, where do we go from here? What you need to look at is the highs from a couple of weeks ago and the lows from yesterday, April 10th. That's going to bracket this new trading range. If we break below, you really got to watch out for more selling pressures. Around 1347 on the S&P, which is a little lower than we were yesterday. But those highs and lows are going to be this new trading range. If we break above the new highs, we're going a little bit higher. But if we break down below those lows, this could be the beginning of a downtrend. I have said all along that I think the downtrend is going to happen early in the year, meaning before the elections. So I actually think the market will rally into the election. So if it's going to happen May, June, July, somewhere in that time frame. So we're very cautious. We're putting a safety net underneath all of our positions. We have lightened up. We're a little bit early on the lightening up process because we're timed it pretty well on the getting in process in November and December. So a lot of people believe in gold still as well. Gold had a little pounce in here too, but gold does not seem to be the fear trade right now. There is still hope, I guess, that the Fed will come to the rescue, as it has many times. But how real is that rescue? Wall Street Journal put out an article on March 28th stating that 61% of the debt that's been issued in the last couple of years is bought by the Fed. That's like saying, the left hand saying we need some money to buy these, to pay, to issue bonds, and the right hand saying I'll buy those bonds, and now suddenly we have this money to pay off our debts. It's really not a long-term solution. So the problems that you see in Greece with austerity, Italy, to some degree Spain, those problems can find themselves here at some point in time. We really don't want to continue with the debt. We'd like to see the market and the economy recover on their own without more Fed intervention, without more Fed printing of money. So the economic news has been slow but positive here in the U.S. It's slowing in China. They have good growth rates, better than ours, but 6%, 7% growth in China, while it's great for here, is really bad for them, could be considered a hard landing. We're seeing commodity prices sell off substantially, watching copper quite closely. Copper is a leading indicator for the stock market. It's dropped precipitously lately. So there's a lot of warning signs out there. So short term, meaning over the next week or so, I'm more optimistic for a little bit of a bounce, a little reprieve in here. But unless we take out that old high, I think we may have seen the top at least for the next several months. As we head into the election, I think a lot of these people want to get reelected. They're going to do what they can, say what they can, try to make the market look a little bit better. But we're in the beginning of earnings seasons. Alcoa knocked the ball out of the park with a revenue growth rate beat and a earnings growth rate beat. That was good. However, year over year, it was still negative. Basically, their earnings and revenues year over year were not as good as they were in 2011. So, what they've done is the analysts have lowered expectations. It depends on how the perception is on stocks as they beat these lowered expectations, and we'll see what happens going forward. Again, I'm Jerry Slusiewicz. This is another one of our Money Talks podcasts. If you want your free portfolio review, call my office, 800-449-9501, or sign up for our free email newsletter on the web at www.yourmoneytalks.com. Have a great week of investing.